Guys, the sun is out. The sun is out this week. Honestly, it's so nice. It's transformational. Mood and everything. Where's my water? So we all know that it's notoriously difficult to beat the market. The professionals struggle, the papers struggle, the financial magazines struggle, the YouTubers struggle, and basically everyone struggles. But me being me, thought, why do we want to beat the market anyway? Let's just get to know the market and accept decent returns in the long run. But how? So with the FTSE 100 crossing the 7,000 mark this year, optimism from the vaccine rollout, and just all round dire UK market for the last few years, even before the virus, I am naturally allocating more of my money to the UK and the flagship FTSE 100 index. Call it profit taking from the US. And why is the UK so attractive for investors right now? Should we be thinking about UK versus US stocks? It's getting a lot of coverage in the press, so let's cover it right here. It's all about the Cape. Now, I have talked about the Cape ratio at the start of the year, which was signaling that the US markets were overvalued and due for correction. And we have had a correction this month during May due to inflation fears. Now, I do have a few videos on inflation and also a bit more on Cape ratio at the start of the year. So I'll link those at the end or in the description if you want to check them out. But don't click away right now because I'm going to get into the juicy stuff. The Cape this year has been my comfort blanket. I'm not gonna lie, honestly, it has. So let's sprinkle those facts. It also gave me a nice sense of where the market is. I tend not to do anything drastic because, as you know, I just invested passively into the world because I own two humans and I can't take those risks that I may have 10 years ago. Understanding how the Cape works is a great way to value the long-term market and get a sense of as to whether the market is cheap or expensive. That can be quite dangerous for short-term investing, but over the long haul, the market follows the long-term trend, which is what we're all talking about, long-term investments. And right now, the UK is cheap on a Cape basis. But what is Cape then? Tell me. So stock pickers use earning multiples to rebase a stock, and this is all a little bit technical, so bear with. And they make it easier to compare like for like, essentially interpreting how much of a company's earnings you buy when you buy a share. And very simply, it's called earnings per share. To then check whether a stock is cheap, you use the price of the stock and compare it with the earnings per share. Like I said, how much we pay for a company's earnings when we buy a stock. So by dividing one with the other, we come up with the ratio. The higher the ratio, the more we need to pay for a company's earnings. Again, in itself, it's not very useful. If you start comparing within a sector or industry, it becomes more useful in assessing which companies are cheaper and more expensive relative to their peers. The other main weakness of the PE ratio is that it's always benchmarking versus 1 year of earnings. So cyclical companies could look more expensive or cheaper depending on their economic cycle. House builders, for instance, have an economic cycle that can last a few years. Mining, on the other hand, typically has an annual cycle. So if you're analyzing one stock, you might be able to factor it in and figure it out, but we don't stock pick here, so we're not really trying to figure it out anyway. And secondly, when looking at a market such as the UK, we have a mix of companies that have different economic cycles. That's where the Cape comes in. The Cape assumes an earning period of 10 years and inflation adjusts those earnings. The beauty of the ratio is that over the long term, Cape behaves like the PE. Where it's high, the market returns are lower, and where it's lower, the market returns are higher. But long story short, or long story, whatever, buy when the Cape is low for better long-term returns. That being said, there is one major criticism of the Cape, which is that it's been suggesting that the US has been overvalued since 2014. But despite that, the US market has been delivering 14% per annum, which is just fantastic, isn't it? And economists have explained this after the fact, I might add, that low interest rates have pushed up Cape in general. So Barclays have a fantastic section on the website dedicated to Cape, in case you fancy a little bit more. But let's avoid getting into the nooks and crannies of the Cape ratio and just pick up a couple of trends from the graph above. Blue is the US and green is the UK. It also shows two things. The US has been rising and now it's quite high, not gonna lie, indicating as investors that when we buy US companies, we're paying much more for earnings than a decade ago. And second of all, the UK has just been hopping in a nice fancy circle or moving sideways for the same period of time. It's a little bit of a joke really, isn't it? But what does that mean then? So stating the obvious here, but it does mean we should look elsewhere for better deals, right? But where do we find those better deals? Well, the UK, obviously. Now, I'm not saying that you should ditch the US. That would be stupid. So the US makes up about 50% of the global equity market, so we should have it in our portfolio, and a good chunk of it too. However, instead of trying to pick the next big penny stock and trying to make £1 million in 24 hours, we just have to adjust our asset allocation of our passive portfolio to include more UK while it's so much more cheaper. And that seems to make a lot of sense to me. Now, going back to that Barclays graph just here, what is the quantum of cheapness? I just made the term up and it feels like it's part of a James Bond movie title, I'm not gonna lie. But the UK is about 40% cheaper than the US, making it cheaper than Italy and many emerging markets. And actually, let's just take a step back. The UK is cheaper than the US. It's also cheaper than an aggregate of the European Union, and it's cheaper than all of these countries as well.
Australia, Brazil, Canada, China, France, Germany, Hong Kong, Italy, India, Israel, Japan, Korea, Mexico, Netherlands, South Africa, Spain, Sweden, Switzerland, Taiwan, Turkey.
Now, personally, I don't think that feels right, do you? Nor does the market. The big US investment banks are now showing that global fund managers are going long in the UK, and it's the first time since 2012, so that's saying something. There are a few other factors that are helping as well. The switch from tech momentum stocks to value stocks, which is fueling more interest in the UK stock market. But speaking of tech crashes and just market crashes in general, it's important to remember the basics. Now, we all know that trying to time the market crash is a bad idea, but everyone wants to find out for themselves and give it a go. I don't know what it is exactly, whether it's a combination of nerves, greed and fear, but here's a video where we talk all about timing the market. I'll see you over there.